Hey everybody, and welcome to Aceland Presents non-QM updates for 2022. Okay, so here's a quick overview of some of the non-QM products that we have because there's been some changes that have happened with the product. So a little bit about myself. My name is William Halick. I go by Bill. I've been in real estate for over 20 years. I've closed close to $1 billion in volume during my career. I've been recognized as a top producer when I was an account executive with JP Morgan Chase. I've lived abroad in Sevilla, Spain, where I practiced my Spanish. We're licensed in a number of states: New Jersey, Pennsylvania, Connecticut, Florida, Texas, and of course, Puerto Rico. I've traveled extensively throughout the rest of the world, throughout South America, Central America, Canada, most of Europe, and parts of Asia as well. I earned my MBA from the Rutgers Executive MBA program, which is a top 100 ranked program according to the Financial Times magazine and newspaper. We were the first mortgage brokerage licensed to write loans in Dominican Republic in 2007. We've been writing non-QM loans since they were released back in 2010, and we were the first brokerage to bring non-QM here to Puerto Rico. So you can reach me at 800-254-3150, or you can email me at bhallick@acelandmortgage.com. So that's just a brief introduction to who I am, what my background is, and why I can help you with your mortgage needs. Okay, so non-QM, right? You've maybe heard this term thrown around, or maybe you've never heard it before. What is considered a non-QM loan? A non-QM loan or non-qualified mortgage is a home loan that is not required to meet agency standard documentation requirements as outlined by the CFPB, the Consumer Financial Protection Bureau. Non-QM loans encapsulate a wide variety of mortgages, including home loans exceeding 30-year terms and a number of other specific things that the loan may or may not have. What that means is that a loan that doesn't meet agency guidelines means it's a loan that is not going to be able to be sold to Fannie Mae or Freddie Mac, which is typically where most folks are going to go get their loan. I believe 8 or 9 loans out of all the loans that are written in the U.S. end up being purchased and sold in the secondary market with Fannie and Freddie Mac. Now those numbers will change here and there because prior to the crash in 2008, a lot more of that paper was not Fannie Mae and Freddie Mac or agency as it's known. And then as time has moved forward, we're seeing the private sector of mortgages expand again. But this time they're doing it a bit smarter. This is not the same as what was dubbed subprime prior to the 2008 crash. Okay, so just a little bit of a understanding of what this whole non-QM world is. And what's the difference between a QM loan and a non-QM loan? Well, the significant difference between a QM loan and a non-QM loan is going to be that a non-QM loan uses alternative method of income verification versus what you would find for a Fannie Mae or Freddie Mac style, agency style of loan. Okay, so that's really the big difference. We could go into a whole thing about the history of all this, but none of that really matters right now. What matters is helping you get your non-QM loan, which really means helping you acquire the property that you want to buy, is specifically in the Puerto Rico market. So there's a number of different loan options that we have available. I'm going to go over a couple right here. This is 4 quick ones. You have what's called the DSCR. It's pretty popular, that word, that acronym. You'll see it thrown around. We'll go over that in a minute. Then you have your bank statement program. Okay, then you have what's known as a P&L, profit and loss. And we also have a bridge loan and a number of other loans. I didn't want to go into all the products because this is supposed to be a very quick and brief webinar. This is not intended to go deep into everything. It's going to give you enough information to really understand what's going on. And then if you need to learn more about it, you can just reach out to me and I'd be glad to help you. So let's go to the DSCR, which is I don't want to say it's the number 1 product, but it's probably one of the most popular products. So the first thing you have to understand, this is not a loan that's for a primary residence. Okay, so you cannot use a DSCR loan on your primary home that you intend to live in. Why is that? Because a DSCR loan, by its nature, is a commercial style underwrite. It's designed for an investment property or a property that you're not going to live in. Well, why and how does that work? So typically, when we're underwriting you as a borrower, right, you're buying your primary home, we're going to look at you and your income, right? Because what we need to know is who's going to pay back the loan, right? So we're going to make you this loan for however many dollars, and you need to be able to pay that loan back. So we have to do an analysis to figure out how you're going to do that. And we'll go into some of that for primary loans in a minute, or primary homes, excuse me, in a minute. But for an investment property, we don't have to look at your income per se. What we want to do is with the DSCR loan is look at the property itself as a small mini little business, right? So in a business, you have your revenues, which is your money coming in, then you have your expenses, and then you have your net income, right? So in a DSCR loan, all that really stands for is debt service coverage ratio, which is the ratio of money coming in to money going out. And what is money going out on? The expenses for a property are going to be principal, interest, taxes, and insurance, which is also known as PITI. So you've heard that acronym thrown around, right? So your principal, interest, taxes, and insurance, right? Principal interest is basically the money you've borrowed. Taxes are the taxes on the property, and insurance is obviously the insurance on the property. So what we do is we're going to take the net operating income of the property, and we're going to divide it by the debt. So for example, if the property brings in $3,000 and costs $3,000 per month, that would be a 1% ratio. Banks typically want to see greater than 1. They like to see 1.25 or better. Okay, what does that mean? That means that the property is bringing in more money than it's actually spending on the expenses. I mean, and if you're buying an investment property, doesn't that make sense? Do you want to buy an investment property that loses you money? Typically, no, right? You want to buy a property that makes you money. So banks want to see a ratio that's higher. Okay, now in Puerto Rico, appraisals can be an issue. Okay, so, and we'll talk about that also a little bit later on in the webinar. So because that can be an issue, sometimes the long-term rents for a property that you're looking to purchase may not cover the debt service ratio, may not cover the debt service coverage ratio, may not be good enough, meaning you could be under 1. Okay, so what does that mean? That means that the property is bringing in less money than the actual expenses. Okay, but don't worry, because we still are allowed to write the loan. In fact, we can actually go down to a debt ratio of 0 and still write the loan. So that sounds kind of crazy in a sense, but you have to understand, for example, if you find a property that's in a highly desirable area that's going to be for, let's say you're going to have folks that come in and they want to do like an Airbnb, for example. So what's going to happen is the Airbnb short-term rents are going to actually be much better possibly than the long-term rents. Okay. However, you're not going to be able to show that debt service coverage ratio with short-term rents because you have no real history to prove that. Now, if you're buying the property that's already existing short-term vacation rental, and let's say the person that you're buying it from does have historical income that they can prove via, let's say they're using, again, I'll just use Airbnb as an example because it's probably the biggest. They provide a printout of the revenues and the income that you provide that you're earning from owning the property. So if you're able, as the buyer, to get your hands on that from the seller, we could possibly use that to show the underwriters and say, hey, look, this property does have a historical of earning this much money. But again, it doesn't matter so much because we can still write the loan even if we're under 1% coverage ratio. So really, at the end of the day, you don't have to worry so much because you're still going to be able to acquire the property. Now, the pros and the cons are if you have a better than a 1.25% ratio, you're going to get a slightly better interest rate than you would if you're going to be under 1.25. But it's only about maybe a 0.25% difference. So it's not something to, completely lose your mind over. So that's really all a debt service coverage ratio or DSCR loan is. Okay, so all we're really doing is simply looking at the property standing on its own 2 feet. Does it bring in enough money to cover the costs? The answer is yes, then the rate would be A. If the answer is no, we still get the loan. It's just going to have a different interest rate. So in either case, you could still win, aka buy the property. And you can do this also for a refinance. So if you've already purchased a property with your own cash, you can get back up to 70% of whatever, depending on how long ago you bought it, right? So there's a thing called seasoning. So if you purchased the property a week ago, you're not going to be able to get, let's say you bought the property and it was a steal, and on the open market you could get $2 million for the property, and you're like, well, I want 70% of that $2 million. You're not going to be able to do that if the property hasn't seasoned, if the title hasn't seasoned, meaning you don't have a period of time, 6 months, 12 months. Okay. So what you want to do is, if you just purchased the property, we can get you back 70% of the purchase price or the appraised value, whichever comes in, whichever is lower. So it's a conservative approach to underwriting. That's a very typical thing across the board in all underwriting. But at the end of the day, at least you're able to still get back, some of your money, which is a beautiful thing because that allows us to do, to be able to refinance, take that money back, and go possibly buy another investment property. Okay, so that's number one on the slides here. On number two, you'll see is the bank statement program. So what is that? So now a bank statement program could be for an investment property, or it could be for your primary. So in this case, you would be able to use a non-QM loan to purchase a home as your primary residence. Okay. Oh, let me just get rid of this. Excuse me. Okay, so with the bank statement program, 24 months or 12 months of income. What does that mean? So if you have a business that's been open for a number of years, the longer you're able to show consistent cash flow, the better the interest rate's going to be. That's really the only main difference. Meaning, if you have the 24 months to do, we might as well show it because we'll get a slightly better interest rate. If, for example, you have 24 months, but the previous 12 months are not as good, and they're going to bring down your income for your current 12 months, and you need that income for the debt ratio to qualify. I mean, this is the analysis we would do. In that case, I would suggest we only go with the 12-month bank statements to make sure we're able to hit the debt ratio. In this case, it's not a DSCR. It's just going to be a regular DTI, debt to income ratio, because I'm assuming in this example that you're buying using the bank statements for your primary residence. We'll go into some of the guidelines for that later in the slide. But just know this is designed for self-employed people who have a business that show a lot of cash flow that runs through their bank statements, which may not show the same way as they write off their tax returns. Okay, so that's where the bank statement product comes into play. Number three is the P&L product, profit and loss. Very similar to the bank statement program. Big difference here is instead of bank statements to underwrite your income, we're going to look at a profit and loss statement that's being provided by either your CPA or your tax preparer. It does not have to be audited, which is a huge factor, but it does have to be provided by your CPA or tax provider. And what ends up happening is you have, again, this is for self-employed people. You can use this for a primary residence. And what we're going to look at is your revenues, less your expenses. Let's look at that net income. Okay, that net income is going to be then utilized to make sure that you're able to afford the property, and it's going to cover on your DTI. Again, this is DTI because we're looking at, this is potentially for a primary residence. You could use it for investment property as well if needed. It all depends, but typically the P&L is going to be more for a primary residence. And number four on the list is a bridge loan. A bridge loan has no income on the application whatsoever. You cannot do renovations with a bridge loan, with this particular bridge loan for here in Puerto Rico. If you have a property that needs renovations, that's going to be a completely different webinar and a different product. We can talk about that in a different seminar, or just call me. I'll help you explain. I'll explain it to you so you can understand it better. But a bridge loan in this sense is typically for an investment property. Bridge loans are not for your primary. Okay, so it has to be an investment property. No renovation, like I just mentioned. And we're not going to look at any income whatsoever. The application 1003 is going to basically be blank. You're going to put down, I believe it's 30 or 35% down payment, and the rate's slightly higher than the other examples because in this case, we're not really looking at any of your income or the property's income, but they're still going to let you use the loan to buy the house, or you could refinance with it. A bridge loan is it's a short term, typically. It's not going to be a 30-year fixed. The other loans I just mentioned, the DSCR, the bank statement, and the P&L, all of those come in a 30-year fixed flavor. The bridge loan is going to be probably a 1 or 2 year loan. It's more of an acquisition loan. The fact that it doesn't have renovation allowed to be included in it means that it may not be that advantageous, and there may not be a lot of times when you can use it, but it is a product that's good to have, and it's good to know that it's out there and that we have it. So some updates in the next slide here that I want to go over in Puerto Rico. So there's some overlays and some differences in Puerto Rico than in the mainland states. So yes, we can do non-QM here in Puerto Rico. That's the best news. Some of the conservative hedges that have shown up since we rolled this product out back in the summertime is that, for example, crypto. So when we initially had the product, we were able to give 90% of whatever your crypto value was. We would give you credit for that as assets. So for example, if you had $10 million in a crypto account, we would give you credit for $9 million, right? They're going to hedge it by 10%, so you'd get $9 million. And we have also had an asset depletion program whereby you could take that $9 million and then divide it over 60 months, and that would give you your monthly income. Today, because of the volatility and basically just a contraction in the overall market, because of what's gone on with inflation, et cetera. On the secondary market, there's been some liquidity issues. Currently, at the time of this recording, which is mid-November 2022, crypto is now getting credit for basically zero at the moment. So unfortunately, if you have crypto, whereas just a few short months ago, you were able to get 90% value, today they've suspended all value on that. So that's a huge thing, especially here in Puerto Rico, because we have a crypto haven, let's call it, of folks who've come here. And because of what's going on in crypto, now I think that'll change, but that's just a thing to know right now. Okay, what other overlays or concerns should we be aware of? So the second thing is, here in Puerto Rico, there's 2 appraisals required every time. Why is that annoying? It's annoying because it's an additional expense. It can potentially add more time to the process. When we first came out with the product, it was not required. It was typically for only loan sizes that were over $1 million. However, it's been expanded to include basically any non-QM loan here in Puerto Rico, even if the loan size is, 500,000 or 200,000. So it's something to be aware of. It's a small change, but it can impact your timeline. Folks always want to close quickly. Sellers are very pushy. Sorry, sellers, it's true. And nobody has any, relaxedness when it comes to real estate. There's a lot of tension and people are nervous. So the additional appraisal can add a little bit of time to that, because now we have to get a second appraisal. Something to be aware of, just bringing it up. Number 2, max LTV, loan to value here in Puerto Rico with the non-QM product is 70%, which means you have to put 30% down on a purchase, or if you're refinancing, you can get back up to 70%. Again, some of these products stateside, we can go to say 80, 85%, but here in Puerto Rico, we are capped at 70%. Just something to keep in mind. Again, this is specifically for non-QM. FHA, conventional, all that stuff can go above a 70 LTV. This is specifically for that non-QM product. Third thing is, you must use a specific notary. So this is an evolution of the product. It wasn't that way when it first happened. But there's been a designated person for the notary function in the Puerto Rico real estate transaction. And if you need help with that, obviously, if we're going to work with you, we would make sure you have access to that person. So it's just another thing to be aware of. Not really a big deal, but just something to be aware of. And one thing that's not on this slide that I know is true is, with these non-QM loans, they require your homeowner's insurance to be paid prior to closing. Why is that important? Because typically in the States, you can bring the invoice of the insurance to the closing and have it be part of your closing cost and pay at the closing. However, here in Puerto Rico, I don't know if this is an investor overlay or whatever the case may be, it's something to be aware of. Why does it matter? It matters because of timing, right? If you go to a closing and you haven't paid your insurance yet, and you were thinking, oh, I'll just pay the invoice at the closing, and then all of a sudden you go to the closing and you didn't do that, you could delay your closing. And again, nobody wants delays. Everybody wants our closings to be smooth. So it's just a simple thing. We'll find you, you go out and you find an insurance agent that can help you get your homeowner's insurance, and you just have to simply set it up and pay the invoice prior to the closing. Just another little tidbit there. So overall, those are a couple of overlays at the moment that are going on. Check back with me periodically, because the market is dynamic and these will ebb and flow. So if things get more constricted, you could see that LTV drop. If things get more, if the economy recovers more quickly, we could see that LTV expand, just as an example. So the best thing to do is give me a call and to check in to make sure, hey, have any big guidelines changed since the last time we spoke, or the last time I watched one of your videos, etc. So that being said, this was just a quick overview of some of the changes on non-QM here in Puerto Rico. I want you guys to really know that I'm a resource here for you. We have loan officers here on the ground in Puerto Rico that can help you with all your non-QM needs. We're looking forward to continuing to provide these kind of loans for our clients. And again, we do this in a number of states, so check our website for the licensing. Today's webinar was specifically more geared toward Puerto Rico and what we're doing here. And we're excited to be part of the community, and we're excited to help folks renovate some of these properties. Again, we'll talk about that on a different video, and to fix the stock of housing here in Puerto Rico to help people have more homes to live in and really to continue to beautify the island and the communities that we live in. So we're excited to be here. Thank you for your time on this webinar. You can reach us at any of the places here on the website. You've got www.acelandmortgage.com. You can find us on our website. You can call us at 800-254-3150. And of course, you can email us at either info@acelandmortgage.com or bhalick@acelandmortgage.com, which is my personal email. So I look forward to helping you guys close your deals. Agents and clients, I look forward to helping you with all of your real estate financing needs. Give us a call. Thanks again. Have a great day.